Welcome back to our channel. Today, we're going to talk about a topic that affects each and every one of us: inflation. Many people hear the term inflation thrown around in the news, but do you know how it can impact your personal finances? Well, you're in the right place. In this video, we'll dive deep into the world of inflation and explore its effects on our wallets. So, let's get started. Before we dive into the impact of inflation on personal finances, let's start with the basics. What is inflation? In simple terms, inflation refers to the general rise in prices of goods and services over time. When inflation occurs, the purchasing power of your money decreases, meaning you can buy fewer goods and services with the same amount of money. Over the years, we have witnessed different levels of inflation, ranging from mild to high. Inflation rates are typically measured using various indices, such as the Consumer Price Index, CPI, and the Producer Price Index, PPI. These indices track changes in the prices of goods and services, and can give us a sense of how inflation is affecting our economy. So, how does inflation impact our personal finances? Let's take a trip to the grocery store to find out. Imagine you have a budget of $100 for your weekly grocery shopping. A year ago, with that $100, you could buy a cart full of groceries. But due to inflation, the prices of goods and services have increased, and now that same cart of groceries may cost you $105 or more. This means that your $100 budget doesn't stretch as far as it used to, and you may have to cut back on other expenses or dip into your savings just to maintain your current level of spending. The impact of inflation goes beyond just grocery shopping. It affects various aspects of our personal finances, including savings, investments, debt, and retirement planning. Let's take a closer look at how inflation can impact each of these areas. First, let's talk about savings. Many people keep their savings in bank accounts, which typically offer interest rates. However, when inflation occurs, the purchasing power of your savings can be eroded. If the interest rate on your savings account is lower than the inflation rate, your savings may not grow enough to keep up with rising prices. This means that even though you may have the same amount of money in your savings account, it may not be worth as much in terms of purchasing power. To combat the impact of inflation on savings, it's important to consider investment options that have the potential to outpace inflation, such as stocks, bonds, real estate, and other investment vehicles. These investments can provide higher returns over the long term and help your savings grow at a faster pace, helping you preserve your purchasing power. However, it's important to note that investments come with risks, and it's crucial to do thorough research and seek advice from a qualified financial professional before making any investment decisions. Speaking of investments, let's talk about how inflation can impact your investment portfolio. Inflation can affect different types of investments in various ways. For example, fixed income investments like bonds may see their purchasing power eroded as inflation rises, as the interest rates on these investments may not keep up with inflation. Similarly, cash investments like savings accounts or money market accounts may also lose value due to inflation if the interest rates are lower than the inflation rate. On the other hand, some investments like stocks, real estate, and commodities have historically shown the potential to outpace inflation and provide returns that can help preserve your purchasing power. These investments tend to perform better during inflationary periods, as companies may be able to pass on higher costs to consumers in the form of increased prices, and real estate and commodities may see their values rise in response to inflation. However, it's important to note that not all investments are created equal, and their performance during inflation can vary depending on various factors. It's crucial to diversify your investment portfolio and consult with a qualified financial professional to create a strategy that aligns with your financial goals and risk tolerance, especially in the face of inflation. Now let's talk about debt. Inflation can impact your debt in both positive and negative ways. On one hand, if you have fixed-rate debt, such as a mortgage or a personal loan, inflation can work in your favor. As prices rise, the value of money decreases, which means that over time, the real value of your debt may be reduced. This is because you are repaying your debt with dollars that are worth less than when you initially borrowed the money. On the other hand, if you have variable rate debt, such as a credit card debt or an adjustable rate mortgage, inflation can have a negative impact. Variable rate debt is tied to benchmark interest rates that can rise with inflation. As inflation increases, central banks may raise interest rates to combat inflation, which can result in higher interest payments on your variable rate debt, increasing your overall debt burden. To mitigate the impact of inflation on your debt, it's important to carefully manage your borrowing and consider the type of debt you take on. If you have variable rate debt, it may be wise to explore options to refinance or pay down your debt faster to reduce the impact of potential interest rate increases. It's also crucial to have a solid debt repayment plan and budget in place to ensure that you can manage your debt effectively in the face of inflation. Finally, let's discuss the impact of inflation on retirement planning. Inflation can pose a significant risk to your retirement savings, as it can erode the purchasing power of your money over time. Consider this: if you're in your 30s or 40s and planning to retire in 20 or 30 years, the cost of living could be significantly higher by the time you retire due to inflation. This means that you may need more money saved to maintain the same lifestyle in retirement. To combat the impact of inflation on your retirement savings, it's important to have a well-diversified investment portfolio that includes assets that have historically performed well during inflationary periods, such as stocks, real estate, and commodities. Additionally, regularly reviewing and adjusting your retirement savings plan to account for inflation can help ensure that you're saving enough to keep up with rising costs of living. Another key consideration for retirement planning in the face of inflation is Social Security. Social Security benefits are adjusted annually based on changes in the Consumer Price Index for urban wage earners and clerical workers, CPIW, which measures changes in the prices of goods and services. However, the cost of living adjustments, COLAs, may not always keep pace with the actual inflation rate, which means that your Social Security benefits may not fully protect you from the impact of inflation. To make up for potential shortfalls in Social Security benefits, it's essential to have other sources of income in retirement, such as personal savings, investments, and pensions if applicable. Working with a financial advisor can help you develop a comprehensive retirement plan that accounts for inflation and ensures that you're financially prepared for retirement. Now that we've discussed the impact of inflation on various aspects of personal finances, let's look at some practical tips for managing inflation. 1. Invest in assets that historically perform well during inflation, such as stocks, real estate, and commodities, to help preserve your purchasing power. 2. Diversify your investment portfolio to spread out risk and maximize potential returns. 3. Consider refinancing or paying down variable rate debt to reduce the impact of potential interest rate increases. 4. Have a well thought out retirement plan that accounts for inflation and includes diversified investments and other income sources. 5. Regularly review and adjust your financial plan and budget to account for rising costs of living due to inflation. 6. Stay informed about the economic landscape and inflation trends by following reputable financial news sources. 7. Seek advice from a qualified financial professional to help you develop a comprehensive financial plan that addresses the impact of inflation on your personal finances. In conclusion, inflation can have a significant impact on personal finances, affecting everything from everyday expenses to investments, debt, and retirement planning. It's crucial to be aware of the potential risks of inflation and take proactive steps to manage its impact on your financial well-being. Remember to diversify your investments, carefully manage your debt, have a solid retirement plan, and seek professional advice to make informed financial decisions. Thank you for joining me today, and I hope this video has provided you with valuable insights into the impact of inflation on personal finances. Be sure to subscribe to our channel for more informative videos on personal finance and other related topics. And as always, remember to stay financially informed and empowered. See you in the next video.